Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. I'm John Mulville. I'll be presenting today's overview of 2010 and our national recap for the year. You can always find our upcoming schedule at www.realestateeconomics.com, and you can view past webinars at youtube.com, Real Estate Economics all spelled out. Go to the button at the top called All, A-L-L, select the webinar you'd like to watch, and see our past presentations. Please join us next week. We have a special event, December 15th, 2010. Mark Bowd, principal and owner of Real Estate Economics, will be unveiling our new website. In our recap of 2010, we just really can't envision a topic that's been more important to what's taken place this year than economic growth and the conditions going forward. So let's start there. Here's our national chart of gross domestic product. You can see in 2008 we had a recession being defined as 2 consecutive quarterly periods of negative GDP growth. We had that happen in the back half of 2008. We also had that happen, continuing the recession, in the first 2 quarters of 2009, with an official ending called out for about mid-2009. Now, what typically happens coming out of a recession is you should get 6 to 8 to 10 periods of sustained high GDP growth, typically above the 4 or 5% that we've shown here. The fact that this particular recovery fell back to less than 2% in the second quarter of 2010 was of considerable concern to the Federal Reserve, politicians, the president, of course, and the whole political business structure. We've really got to see several sustained periods of high growth to recapture the employment that were lost in any recession, never mind a recession as deep and significant as the one we just experienced. Let's take another look at U.S. economic activity going back to 2001. This is values for ISM, that's the Institute of Supply Management. They conduct surveys across a variety of areas across the country. These are coalesced into an overlapping lines here. You can see the recessions are in gray. The ISM data tends to be a great leading indicator for manufacturing activity. You can see going into the past recession, the lines dropped below 0 ahead of the recession. And once these lines started to show tremendous improvement in 2009, it wasn't that long before the recession officially came to an end. The problem that we're really experiencing here is after a very tepid growth in 2010 up to over 1%, we've started to retrace that, and that retrenchment has been really the source of tremendous consternation among the Fed and public officials at all levels. Let's look at national employment going back to 1990. The scale at the left, 110 million jobs in the U.S. as of 1990, ramped up very, very nicely to 130 million in the year 2000. It's normally accepted that the economy needs about 150 to 200,000 jobs a month to accommodate population growth. So we had that really through the 90s. If you look at the little peak in 2000 and the subsequent drop, that syncs up just about right with the tragic events of September 11th. Then we had a very flat spot into an area that we recognized was a recession in 2002, only to ramp back up again. Now the problem that we've got here in 2010 is flat, absolutely flat employment growth. We're not yet recapturing the jobs that we lost from 2008 to 2010. So how does that manifest itself on the ground? Labor is, there's surplus labor. Labor is abundant. Labor is plentiful and cheap. So what happens to average hourly earnings? We're getting very minor readings above and below the 0 line, showing us that labor has no pricing power. People are willing to work for less. I believe a recent Zogby poll showed that 25% of all respondents were making less money today than they were 5 years ago. There are few industries where the workers are able to command wage increases. There are union contracts that get you labor increases. So if you take out those, then the rest of the labor force is actually suffering net degradation in terms of their wages. So what happens? The Federal Reserve takes action to improve the economy by lowering rates. All very typical. You can see the recessions in gray here. When the economy softens, rates tend to come down. It looks like they've come down a little bit more in each of the last several recessions. Usually they don't stay down there this long. Look at this particular experience in 2009. We've had near zero rates for roughly about 1 3/4 years at this point. So what happens when rates are at zero? Capital is very cheap. So capital flows into capital-intensive investments and industries that normally wouldn't be able to attract as much investment. Look at gold. Gold doesn't pay any interest. It costs money to store. Tons of capital going into gold. Technology. Businesses try to invest in technology instead of workers, so there's a lot of money flow there, plus it's capital-intensive. And commodities. Everyone's seen money flow into commodities around the world. Cotton, for example, is at a 15-year high. Gold, silver, all the metals, molybdenum, copper, rare earth metals are suddenly very hot. But it really goes into agricultural products too. Corn, wheat, sugar, all these things have been receiving a lot of capital flows when money is this cheap. Domestic savers are punished. Look at CD rates. Retirees have no good outlets for their money. Foreign investors, by comparison, are rewarded because U.S. assets become very inexpensive. So what happens? Risk-tolerant investors search around the world. These guys are going all around the world putting money into emerging economies and less developed economies. There's been stories recently how Brazil and Thailand have sought to restrict this flow of money in. It's usually desirable to have international investment, but when it wants to come in and out too quickly, it can be destabilizing. By comparison, risk-averse investors have very few outlets. They're stuck in CDs, they're stuck in U.S. Treasuries, and they're stuck in cash, all of which are overinvested by historical comparisons at this point in time. And another manifestation, weak U.S. dollar, which is really a pay cut to U.S. workers. When foreign workers are making more on a relative basis, foreign goods cost more on a relative basis, that erodes U.S. wages and U.S. purchasing power. And as I mentioned before, many companies are going to seek to improve hardware and software to get more productivity out of their workers. We can see that in some of the subsequent slides here. Our unit labor cost index since 2008, we've seen unit labor costs come down very steeply for manufacturing, almost as steeply for non-farm businesses. There just isn't any pricing power in terms of labor or the worker side at this point in time. And frankly, you can make an argument that labor needs to be cheaper here still. We'll talk to that a little bit later. So what also happens in a recession? Businesses are forced to try to get more work, if you will, out of each employee. We've seen that everywhere. People are talking about, gee, I do the job of 3 people, they let 2 people go, and I got their work. This goes on and on. At the same time, the worker takes the point of view that, hey, I need this job, I'm going to work very hard, and so we get tremendous increases in business productivity. You can see that in 2009, 15%, just really an unbelievable rate historically. What happens is there do tend to be limits to how fast and how sustained these periods of growth can be, and at the end, more workers are typically needed. We haven't really seen that yet, and so economists across the country are hoping that we're getting to the point now where workers will start to be added. I've shown a worker tenure by industry, found this to be very interesting. This is a U.S. Bureau of Labor Statistics compilation that they do over many years, and so the data tends to be a little bit slow moving, but it's really showing to us here that there's been a transition from a preference to be in the private sector. Years ago, the private sector paid better, there was more opportunities, you could move up, you could get rich. It was a little bit more cutting edge and fast moving, but in the last few years the public sector has caught up tremendously. There's been huge improvements in wages, huge improvements in benefits, pensions, job stability. So now workers are tending to stay in the public sector much longer than the private sector. That's probably something that will unwind here in the next few years. Let's talk to non-farm payrolls. This is total U.S. non-farm payroll, and we're also going to talk to labor force participation. It's generally accepted that the U.S. economy needs about 150 to 200,000 jobs per month to accommodate population growth. So what we see here is a complete stagnation in U.S. domestic payrolls. We also know that labor force participation, the number of citizens or the number of people in the country who are working, is at a 20-year low. It's down in the low 60% range. That means there's people out there who would be working if there was employment, but the fact is there simply isn't the employment for them to go find right now. You can see in this particular graph we had almost 137,600,000 in 2007, dropping to under 130 million in 2010 with a very slow rebound initially, then picking up steam in the back half of the forecast. Year over year, this is how it manifests itself. This loss of about 7 to 8 million jobs in 2008, 2009, 2010 is very unprecedented. It shows us that the past recession wasn't a conventional inventory recession. It was much more shocking, credit crisis type of a recession. That means the rebuild, the recovery period will be protracted. There'll be a lot more shakeout, if you will. Some industries are winning, some are losing, and those disruptions and gyrations are going to have a tremendous impact on the labor force and on the psychology and demographic patterns that play out over the next 10 years. We'll talk to more to this a little bit later. Unemployment, and I recognize, please, that these are annualized figures right now. For the back half of 2010, we're at 9.6. I believe last week's unemployment came out at 9.8. Essentially, they added workers without adding jobs. This goes back to the labor force participation issue we just addressed. When people got the sense that there might be some improvement in the economy, they tend to come out of the woodwork, if you will, and seek employment. I think we have an excellent chance, in a bad way, of having over 10% employment early next year. At any sign of improvement, people who have not been working and have exhausted their savings and their social safety net are going to come back into the labor force and look for work, which will continue to keep pressure on wages as we just addressed. So what do we do here to reduce unemployment? I think one of the Federal Reserve's responses has been to make capital very cheap. We talked about that a moment ago. Really, the best approach should have been and would be going forward to make labor cheaper. What they should do, cut payroll taxes for new hires and self-employed people. Reduce fees for startup businesses. We know a lot of people aren't working at the large corporations and could be employed at their own businesses. Make it easier for them to do so. I think we should selectively reduce the minimum wage. People say, well, how can you say that? $5.75? No, nobody can live on that. There are parts of this country where there's 30 to 40 to 50% unemployment amongst the youth, high unemployment in some of the older age groups. It's literally criminal that these people can't work when they want to. And if reducing the wage for 6 months a year would help get them hired, we really need to introduce those people into the workforce so that they can gain the skills necessary to get in the workforce and stay. I think we should de-risk hiring. People talk about, oh, I have to give this person a health plan, I have to keep them on, I have to do this, I have to do that. I'm not an expert in human resources, but somehow we have to incentivize hiring and make it easier to do. Improve competitiveness. We've all been talking about health care here. You know, there were some proposals floated to allow interstate competition for health insurance. You know, anything that would reduce that cost and make it easier for people to become hired would be good. Improve labor laws. There's all kinds of uncompetitive labor laws in my state, California, and across the country, which would be a quick and easy way, even if temporary, to improve the labor side of the equation. That's part one today. Please join us for part two of our 2010 National Recap.